So we're going to do number 3 and number 4 together. Number 4 is real short. It's got like one concept to understand, obviously a calculation. Let's go ahead and jump right into number 3. Cherry is the sole owner of an unincorporated business. So whenever you're doing these problems, we saw in the last one, number 2, right? It was investment activity. This is business activity. This is business activity. It actually says business. So if you're told in a problem, hey, it's business activity, you stick with that. If you're told it's investment activity, you stick with that. This is business activity. On 1231X7, sold, right? Now that we're doing characterization, anytime we have sale, exchange, involuntary events, we got to focus on those. So he sold all the assets of his business to Fig for their fair market value. The assets of the business were comprised of the following. So we've got 5 different assets in the business that are being sold. And they're being sold for their fair market value, so we use that as the amount realized. Now, we haven't learned about the sales or purchases of businesses. We will learn about that later, and I have other videos that cover that if you're interested. The idea is, of course, as you all know, most people when they buy a business, they're paying one price, a negotiated price for multiple assets. So it's like a basket purchase. Well, in tax, we have a special way that we allocate for the seller and the buyer the amount, the total amount that's paid. We will, again, that will be talked about in another topic, how we allocate that. But for this problem, we're going to assume the allocation's been done for you. The fair market value is the amount realized. So you're just going to take the amount realized minus the adjusted basis to calculate the gain or loss. So we can go ahead and do that. We can do adjusted basis, well, fair market value, amount realized minus adjusted basis. We can calculate for each of these items. So let's go ahead and do that first before we talk any further. Okay? So in A, the inventory, 37,000 minus 18,000, right? We're doing the amount realized minus adjusted basis. And by the way, I know I've done them out of order. And that's because the CPA exam, they'll like to do stuff like flip around like that to see if you can still, maybe you'll do the opposite and get it wrong. They try to like trick you up on those types of things. So amount realized minus adjusted basis, 37,000 minus 18,000. That's a $19,000 gain. Okay. B, stock acquired on 11X2 for investment. 8,000 amount realized minus 5,000 adjusted basis. We have a $3,000 gain. Okay, C, accounts receivable. We got $10,000 amount realized minus $12,000 adjusted basis. $2,000 loss. D, patent acquired on 11X5 for investment. 3,000 amount realized minus 5,000 adjusted basis. Another loss. $2,000. Then finally, in E, goodwill created by Cherry held for more than 1 year. Amount realized $17,000 minus adjusted basis 0. That's a $17,000 gain. So the way that you determine the consequences to the seller, right? We're Cherry in this problem. We're not Fig. We're focusing on Cherry. Don't worry, again, later videos, later topics, we're going to talk about the buyer as well. Don't worry. If you're wondering what happens, you can see that in a later video. We'll talk about what happens to Fig later on. Or buyers, I'll just say. But the idea is that, as you know, different assets have different character. So the reason why we break up the transaction in different parts is because the transaction will have different parts of different types of characters. You're selling all these different types of assets. You sell inventory and accounts receivable, always going to be ordinary. Ordinary income or ordinary loss. You got 1231 gains and losses. We'll talk about 1231 in our video. Then you report that. You got capital gains, capital losses, you report those. Okay? So that's the idea, is you're going to have a hodgepodge of a bunch of different items. Many items. Okay? So now we've done the gain or loss. That's step 1, right? Amount realized minus adjusted basis gives us realized gain or loss. Step 2 is what is the recognized gain or loss? Well, we do, again, each of these transactions separately. Because it's being sold for cash, right? Sold denotes for cash. There's no non-recognition rule that applies here. Whenever you sell for cash, remember, it's always going to be recognized. So that leaves us to step 3, right? The amount of gain or loss we calculated will be recognized. Step 3 is to determine the character. So that's the last step we have to do, is determine the characterization. So we'll go through each of these. A, B, C, D, E. And again, we're not worried about section 1231 or sub-characterization rules yet. We're only focusing on the general rule, right? Section 1221, 1222, we're talking about, hey, is there a sale or exchange? Yes, we have a sale. Is it a capital asset? If it's not a capital asset, it's going to be ordinary. But if it is a capital asset, it's going to either be long-term or short-term. So the first one, ending inventory. So think about our list of capital assets. Inventory is number one. It's never a capital asset. I'm going to go ahead and tell you right now, inventory always results in ordinary income or ordinary loss. Always. This class, other topics, other videos, you're going to see inventory a lot. Always ordinary income, ordinary loss. Always. It's never going to be recharacterized. Always ordinary. So A is a $19,000 ordinary gain. Okay, B, stock acquired on 1/1x2 for investment. So we've got investment stock in a corporation. That's going to be a capital asset. In previous videos, I talked about, okay, a broker of securities versus a day trader versus just an investor. For the investor, stock is a capital asset. So going forward, whenever you see stock, almost always it's going to be considered a capital asset. Okay? So that stock is a capital asset. Now we have a capital gain of $3,000. Is it long-term or short-term? Well, the business is sold on 12/31/7. It was acquired on 1/1/2. We don't know what the X is, but we know it at least has to be more than a year, right? So therefore, we have a $3,000 long-term capital gain in B. C, accounts receivable, $2,000 loss. Accounts receivable, just like inventory, always going to be ordinary in tax. Always ordinary. So we can go ahead, put ordinary. It's not a capital asset because it's number 5 in our list. Ordinary loss of $2,000. D, patent acquired on 1/1x5 for investment. So we know from our capital asset list, number 4 deals with patents self-created or donated. Well, we're not told anywhere in this problem that Cherry self-created the patent. So we're going to assume that wasn't self-created. And to go further, it just says acquired for investment. So that seems like it was purchased or acquired from maybe the original creator or somebody else. So that means it's going to be a capital asset. Now, it's held for investment, not business, so it's not a business property, right? It's held for investment. So that's going to be a capital asset. It was acquired on 1/1x5, sold on 12/31/7. That means it's going to be a long-term capital loss of $2,000. Finally, E, goodwill created by Cherry, held for more than a year. So self-created goodwill. So goodwill is very difficult. There's been some case law out there that's dealt with self-created goodwill. Self-created goodwill has been determined by the courts to be sometimes capital, sometimes Section 1231, and sometimes ordinary. But usually they rule it's considered capital. Long-term capital gain if held for more than a year. We're going to assume that as well. We're going to talk later in the intellectual property discussion about goodwill, but right now we're just on the basics. So we're going to assume, like most courts have held, that this self-created goodwill held for more than a year is going to be long-term capital gain of $17,000. And that's really everything for 3. You just go through, classify all the gains and losses, and you've determined each gain or loss and the character for each item. Okay, let's move on to number 4. On 22x1, Banana, who operates a lumber yard, bought a load of plywood for $7,000. Expecting an increase in prices, he did not sell the plywood immediately. On 12/20x1, he sold all of it for $10,000. How did this sale affect his income for the year X1? Okay, we've got a sale of property. He sold it, and we've got plywood, which of course is property. So step 1, calculate the realized gain or loss. Amount realized minus adjusted basis. Amount realized is what Banana gets. Banana gets $10,000 minus the adjusted basis. Banana bought it for $7,000, so it's a cost basis. We've got a $3,000 realized gain or loss. Next question, is it recognized? Yes, because it was sold. Sale for cash, always recognized. So now we got to worry about the character. Well, this question, the main focus is, remember, you got to look at how the taxpayer holds the property. So because Banana operates a lumber yard, even though Banana is speculating on prices of lumber, in the hands of Banana, it's still considered inventory. Even if Banana just sold it off as an investment because, hey, I bought plywood for $7,000, maybe there was some issue where there was a fire or something and destroyed a lot of plywood out there available for purchase, and guess what? The plywood went up in value. Even if you speculate. In the hands of Banana, this transaction is still considered inventory. And inventory, remember, is one of our items that are not capital assets, always going to be ordinary. So we have a $3,000 ordinary gain. Now, if I told you that banana was not a lumber yard and just some investor, then it would be capital, right? Because they're speculating on the price going up. Okay? But here, because banana is a lumber yard and holds that plywood, it's going to be considered inventory, and therefore it's considered a $3,000 ordinary gain.